Good morning and welcome to the River UK Microcap Limited investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the top right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review your questions submitted today and publish responses where appropriate to do so. Before we begin, I would like to submit the following poll. I'd now like to hand you over to Lucy Draper. Good morning.
Good morning, everyone. Thank you for joining us today for our regular quarterly update with George Ensor, Portfolio Manager. Just to give a quick refresh on the River UK Microcap investment company, this trust invests in UK-listed companies sub 100 million. It has a unique capital return facility that is triggered when the fund exceeds the optimal size for the investment process. In the past, this has been triggered when the fund reaches between 110 and 130 million pounds. Since launch in 2014, we have returned 77 million pounds to our shareholders. On that note, I'll pass over to George, who can talk you through the latest activity and performance for the last quarter.
Thanks, Lucy. Good morning, everyone. So I'm going to run through, a quick reintroduction. We've done this a few times before, but I think just good to go into what we're trying to do and how we're doing it. And then we'll run through some of our positioning, performance, some of the changes we've made, and also touch on the UK small cap cycle, which is starting to show some signs of life, or at least signs of life on a relative basis, having been a relative underperformer for the last few years. So as Lucy said, we're looking to invest sub 100 million. Why are we trying to do that? We think it's a part of the market that's overlooked. It's very difficult for traditional institutional capital to access. That's why we've got our close-ended investment trust. That's why we limit the size, as Lucy said, to about 100 million, so we can access these microcap ideas. To put it into context, UK small cap, the definition of UK small cap is the bottom 10% of UK listed companies. There's about 1,200 companies, I think, that are within that definition. We are actually looking at the bottom 7% of that index when we're allocating to new ideas, so sub 100 million. We don't really look below 20 million for new ideas. So we're looking at the bottom kind of 0.7 of UK listed companies. We think within our universe, so between 20 and 100, there's about 400 companies. So there's a large volume of companies that aren't easily accessible by institutional capital. They're traditionally covered by one broker. That coverage, those brokers tend to cover quite a few stocks. The coverage tends to be quite low. And so we think there's a brilliant opportunity to take relatively high conviction stakes in a portfolio of about 35 companies, be patient, and hope to see strong earnings growth come through alongside a re-rating. So if I was to give you an example of what we're trying to do, if we were to buy a company and look for it to compound earnings perhaps at 15% over a 3 to 5 year period, then clearly that company you would expect to perform in line with that earnings growth. But because we're looking sub 100 million and they tend to be overlooked and therefore trade on very low valuations, we would also expect to see a re-rating. So if you invest in for example, a 60 million market cap company, compounded those earnings for 3 years at 15%, and the rating improved from 10 times to 15 times, then you'd make 125% return. That company would move from being a 60 million market cap company to a 135 million market cap company. So that, I guess, is the concept. Actually, what happens in reality is the rating is much more extreme, but it is dependent on the UK small cap cycle. So it is in a way dependent on inflows into open-ended small cap funds. It's dependent on people looking for alpha and looking to take on risk in those institutional funds. Because as we've seen, when these companies go up through the market cap thresholds, if they look like promising growth companies, those larger funds strategies tend to allocate a small amount of capital in absolute terms, but that can really drive a significant re-rating. And that's what we've started to benefit from over the last year or so, I would say. And then Lucy mentioned the capital return. It's really important for us that we keep the strategy the right size. We've always said target capacity should be about 100 million. We are actually closing in on that. I think we're kind of mid-90s NAV at the moment. And so once we're over that 100 million market cap threshold, we'll continue to hopefully deliver performance. And within that band of 110 to 130, it's a capital return to shareholders to bring the NAV back down to where we think it is a sensible size. We've got our company life philosophy that the team manages assets by. So as a bit of background, the team, Anna, mine, and myself run this microcap trust. We also run 2 open-ended small cap funds. They run on the same philosophy that we're company life cycle investors. That enables us to do 2 things. The first is we always look at a company depending on where it is in the company life cycle. Also, we analyze a company depending on if it is a growth business, a quality business, or a recovery business. That makes us quite focused and process driven in terms of how we think about shareholder value creation, valuation, and momentum. And it also gives us this style diversification that you can see on the pie chart there, which means that we typically have a spread across those different investment styles. And we think that helps. We think that's actually the best form of diversification. It's been very high profile recently how poor the quality factor's been in global investing, but particularly in the UK. There's been some very high profile concentrated managers who have had a tough time in UK all cap. And so we're always looking to allocate across those 3 different styles. This trust has always had a bias towards growth. And that goes back to if you're looking to invest in a 30, 40, 50 million market cap company, then we do think growth has to be a key part of moving that company from 50 to 100 to 150, which is where we see the re-rating. However, there are companies that transition between stages of the company life cycle under our ownership. So Gear for Music, we bought kind of in the post-COVID, the margins had gone down a long way. The business had taken on quite a lot of leverage. The rating was very depressed. So we bought that as a recovery investment case. We've actually transitioned that business to a growth investment case, as you've seen market consolidation, which has driven material market share gains and growth for that business. And that in turn has driven a significant improvement in margins and indeed in the balance sheet. So that's a good example of a transition from recovery to growth. And that means we can continue to own that company. We just look at it through a different lens. DF Capital is our largest position. We own that as an asset-backed recovery investment case. We bought it. We started buying into it on a depressed price to book. We built our position at a very depressed price to book, more than a 50% discount to book value. That's now approaching book, trades at about a 10% discount to book today. But given the growth that business has, we can absolutely see that transitioning to a growth holding. You could, if you looked further out and if the company deliver on their targets, see that transitioning to a high return on capital quality business as the growth slows and kind of improving return on capital becomes the main driver of shareholder value. So that's some insight into how we think about the portfolio and our investments. Our top 10's over there on the right. Very happy to take any questions on any of those holdings. So on to performance. We've actually had 2 years now of almost 20% NAV growth. I think 2024 was 19.9. 20.6% NAV performance calendar year 2025. We have done this and this is a point we'll come back to, we've done this in, I think, a market which isn't traditionally a great market for us, which has seen smaller companies underperform larger companies. So that mentality of the bottom end of the market re-rating hasn't been seen. We've started to see it come through very recently. Our 3-month performance is on there. We had a relatively good final quarter of last year. Precious metal exposure was part of that performance. We'll come back to attribution. The 5-year number, we are taking a very large bet on the outperformance of the very smallest companies in the market. That kind of goes without saying. It's in the name of the fund. It's very clear in everything we do. In periods of time where there is massive aversion to illiquidity and to very small companies, when small cap funds are in outflow and they're de-risking and removing their illiquid positions, as they did actually in 2018 and as they did again in 2021. That's the hardest part of that's the hardest kind of backdrop for us. And so we had a very poor year of performance, September 21 to September 2022. But we've nicely rebuilt since then, and we can see evidence that I'll come back to later that UK small caps have started to outperform UK large caps, which obviously had a very good year last year. So on to attribution, we've got both the 12-month and the 3-month on here. So we have benefited from M&A last year. Inspecs was bid for in the final quarter. One Spatial, I think, was also certainly bid for last quarter. That was finally confirmed this quarter. So both of those have exited the portfolio. Inspecs we actually sold very close to the bid price. I think there's some concern about whether or not that process will continue now, given a big block that's been built by one shareholder. But we've exited that position, so benefited from the M&A there. You can see we very rarely, so the positives and negatives on here on the attribution by the company name are if we're underweight or overweight those positions. We have very high active money. I think it's 98 or 99% versus that benchmark. So it's very rare for us to have positive or negative contributors, which are stocks we don't own. But such was the performance of gold in the fourth quarter. Creighton Gold was actually a negative contributor for us. Pleasingly, Diaceutics and Traxys have both had very strong Januaries, so recovered from a bit of, I guess, concern over trading outlook for those two companies, but they've both moved on pretty significantly so far this year. And DF Capital, a very large position for us. The market was quite strong. I think there was a bit of profit taking in that business. Again, that's had a very strong January. 12-month performance over on the right-hand side, we had a great year. I'm going to come back to Active Ops and DF Capital. Those are our two largest positions. Reynolds was bid for. SigmaRoc is a business we've owned for a long time. We've owned it since it was a sub 100 million market cap company. We've owned it since they bought their first asset, which is in the Channel Islands. That's a buy and build, aggregates buy and build, then moved into limestone. It's now a 1.5 billion market cap business. They had a very good year last year. They've had a good trading update in January. But that is a business we've been taking the position down in, given the performance, given the market cap, given the opportunity to recycle capital into smaller names. And maybe just on the negatives, litigation capital management, we exited last year. We did exit that just before the very substantial decline, but nevertheless, that was a very painful position for us. The rest of those positions we continue to own. HViva actually had a trading update this morning. So I said I'd come back on Active Ops and DF Capital. So these charts just show you our position size. So the position size is the position size in the fund is the kind of blue backdrop. The market cap is the black line. And then you can see where we've been buying and selling these positions. So we actually initiated our position in Active Ops in 2021 when they IPO'd. You can see that the IPO looks like it was just above 100 million. There was not all of the shares were offered to the market. So I think the free float was about 75 or 80 million. So we participated in that. That came at 5 times sales. The shares went up. They peaked at 5.4 times sales. We then went through this huge derating of long duration growth companies. The company did very little wrong. They didn't beat numbers, but they were delivering consensus expectations. I think they were actually beating on cash. So we took that read from the fundamentals to build our position. And we built our stake, as you can see on here, in 2022 at a very depressed multiple. So we bought into that close to 1 time sales. That business has re-rated. So that trades on about 3.5 times ARR today. It's now about a 7% position in the fund. We think there's further re-rating to go. So we don't think that's an expensive rating for a SaaS business. It's got great fundamentals. I think it's probably one of the fastest growing UK technology businesses at the moment. They delivered about 25% organic ARR growth last year. There was an acquisition alongside that. So this is a good example of where we are very valuation disciplined when we enter positions and when we take stakes in companies. But we do flip from being more valuation disciplined to more momentum disciplined and let those positions run. And that's really important. And so we have a max position size of 10%. And particularly on active ops, we see a very conservative H2 implied revenue and profitability in consensus expectations. We look forward to them updating the market, I think probably in April. And then DF Capital is our largest holding. Again, you can see we put in a small position back in 2021. The business had got a banking license. So the concept was that with this banking license, they could deliver a much higher NIM. Their cost of capital or cost of funding, I should say, rather, dropped. And they'd proven that they could grow a loan book. The market didn't really seem to care about that. So we continued to build on the way down. They did have some challenges with one large loan. That would have been through 2023. So I said earlier, we built this position at more than a 50% discount to book. You can see we built through 22 and 23. The fundamentals were very strong. They've been delivering on NIM. They've been delivering on loan book growth. And then we've started to see that company re-rate recently. It's actually just gone through 100 million market cap. So that helps get it on the wider universe of people that will look at it. As we look forward, the company have come out with 2030 targets. Those targets are for the loan book to grow at about 12 or 13% between here and 2030. That feels pretty conservative to us. The last 5 years, they've delivered loan book growth CAGR of actually 50%. That is from a low starting point with that new banking license, and for a return on equity of 20%. So that puts it amongst the best fundamentals of kind of UK banks. So we think that probably deserves to trade at a premium to book. If you fast forward through their guidance, you get to an NAV of about 135p in 2030. We think it should trade at a premium to that NAV in 2030. So where we are today at 67p, we've still got a view that there's plenty of upside to go. And you can see on this chart, we've been running that position very close to the max position we can have given a 10% limit in any one company. What companies did we buy last year? I think most of these, in terms of quarterly update, I think Carrero was the only one that we bought in the fourth quarter. So Carrero is a cybersecurity business. They're a provider of denied distribution of service protection. They've got a very disruptive pricing model. They seem to be gaining some traction with that pricing model. The IRR growth has accelerated, trades on about 2.5 times sales. So we've been building into that position recently. It's not a massive position yet. Microlize we bought in the third quarter. They didn't have a great trading update in Q4. In fact, it's one of the few companies we've had in the last probably 4 or 5 months that has missed expectations. But we've kept with it. They've had an update this morning, which looks like they've got some stability coming back into the middle. Beauty Tech Group was an IPO we did third or fourth quarter last year. Upgraded expectations twice since then. So we're happy with the progress made there. So those are growth companies. Typically, we allocate to IPOs through IPOs tend to be to growth or quality. And then recovery is a part of the portfolio that we have built out recently. I'd probably flag Sylvania Platinum, which we put into the fund Q2 or Q3 last year. That's obviously benefited from the massive rally in Platinum Group metals. And so I think we've made over 100% return in that position since last year. It is actually still pricing in, on our numbers, probably pricing in about a 30 or 40% drop in the PGM basket price on its current valuation. Sales, M&A has been the big driver. So if you look at the businesses that have been sold in the last year and exited the fund, if you go back to 1st of October 2024, which is the beginning of our last financial year, those companies all represented a total combination of 21%. So that's been a big driver of sales. We had 2 litigation funding businesses in the portfolio. We've exited both of those. We had litigation capital management since IPO. It worked for a while and then didn't. And Manolay, we didn't actually invest in the IPO, but we came into it post-COVID. We thought the way they recognised cases coming out of COVID could accelerate, and they could drive some decent profitability. And then Sarabi and DF Capital. DF Capital we've been selling because we've come up against that limit, and we've just been taking profits from precious metal exposure. So actually taking some profits from Sylvania along with Sarabi. We haven't taken any profits from our position in Capital Drilling yet, which is a top 10 position. So that's what we've been up to. Onto the UK cycle. So I've showed this chart before. It's the big cycles. This is UK small cap total return relative to UK large cap total return. So it's the relative performance of smaller companies to larger companies in the UK. And these are all the big cycles going back to 1990. I guess the kind of punchline on here is there aren't that many days in the last 35 years where on this analysis, there's been a better opportunity to buy UK smaller companies, such as the underperformance over the last 4 years since September 2021. In fact, that you've seen this massive underperformance. So we are rivaling the 1990 cycle. As I've said before, there's really 2 cycles in here. There was a 94, 96 cycle, which nearly got back to parity. And then there was the dot-com cycle. These cycles tend to play out over very long periods of time. We're pretty sure that we're very close, or we're pretty sure that we're close to the bottom of this UK cycle. And I'll come back to some more data we've got on that. We get challenged about the structural headwinds to small cap and whether or not this will ever recover. And that's a bit of a tricky one to argue. My view would be if your definition of small cap is the bottom 10% of UK listed companies, then at some point this will mean revert because you're just talking about large versus small. If you were to take a subset of companies and say, is that group of companies definitely going to recover? That is a slightly different argument. But on this basis, this chart has always reverted back with smaller companies outperforming and making a new all-time high, or at least that had always been the case from when the data goes back to, I think, 1955 up until 2021. So we've used this chart several times to try and build our conviction in the opportunity for UK smaller companies. There's been a massive derating. So that's what's driven that cycle. You can see on here, AIM 2021, AIM was trading on 14 or 15 times EBITDA. That's derated to about 8. In that same period of time, the FTSE 100's gone from 12 to 10 times. So you've inverted. AIM's typically traded more expensive or in line with the FTSE 100. It's now trading at a record discount. You could make the same argument for FTSE small cap. It's trading very close to the low in absolute terms over the last 15 years. And the spread between the FTSE small cap and the FTSE 100 is the widest it's ever been. So we don't think that will persist. We think this is caused by the outflows we've seen from UK equities, active funds, smaller companies funds, and we think it will revert. And this is a different data set. But if we go back to June 2021, which was just after we last made a capital return in microcap, you can see on here the total return of various indices and indeed the microcap trust. So there's been a very clear preference for larger companies over smaller companies. And in fact, we can dig into the smaller cap market and we can see the performance of the smaller cap market. And all of the performance that has been delivered in the smaller cap market has been delivered from the larger part of it. So the last 3 years to the end of December, the small cap market's up 21%, but all of that performance has come from companies that have been larger than 500 million. In aggregate, the sub 500 million part of the market is down over the last 3 years. And that's indicative of the capital that has come out. Interestingly, and this is a very short period of time, but if you look at this on a 2-month basis, and we don't have the chart because it's a very short period of time, but if you take this from just before the UK budget to today, the order of this is the other way around. So the AIM has outperformed, it's up 13%, our NAV's up 12%, small cap's up 11%, and the FTSE 100 is up 6%. So, there is an argument that was a kind of a changing of the guard. We've seen interest rate expectations for the UK fall more in line with the US and Europe since then. We wrote in our Q3 quarterly, that the UK looked like an outlier. At that point, 1 year forward interest rate expectations for the UK were for us to get to 3.6%. We're currently at 3.75. Europe was expected to be at 1.8, and the US was expected to be at 3. If you look at those numbers today, we're expected to be about 3.4. So some additional rate cuts have been priced into the market. The US has actually gone up, so they've gone 3 to 3.1, and Europe's gone 1.8 to 1.9. So you can see that we're going through a kind of gilt yield premium normalization, and I think that's really important for drawing capital back to the UK. We saw that through last year with the outperformance of the FTSE 100. And we're seeing that starting to come down through the market cap thresholds. Again, I've shown this performance chart before. We're just trying to show that in a period where small cap premiums are negative or neutral, which is that fifth line down, it's not the ideal backdrop for us to deliver performance. We really want to have those animal spirits and the outperformance of smaller companies versus large caps. Again, that was the point I made on the previous slide. We have seen that for the last 2 months. We've seen our NAV performance pick up. This is actually dated to the end of December, but I think our NAV's up another 10% month to date in January. And indeed, we've started to see our discount closing is coming from about 18% to 14 or 15%. So we're hopeful that if we go into a regime of smaller companies outperformance, and we haven't seen that for a long time, this period of underperformance of smaller companies is very extreme on a historical basis. If we start to go back into a period of smaller companies outperformance, the first thing we should expect to see is positive responses to positive trading updates in companies. We've seen the vast majority of our portfolio update the market in January. I think 74, 75% of our portfolio has provided updates in January. All but 1% of that 75% has either been in line or outperforming. So one company that guided to the bottom actually beat on cash. With the exception of that, we've had a very positive January for company updates, and we're starting to see that performance come through as well. So we're seeing that kind of, and I don't think that's necessarily that everything in the world's got much easier and companies are starting to outperform. I just think we've been through such a long process of kind of missing poor earnings expectations that companies have just put expectations in such a conservative place that they are starting to deliver in line or even beat them. Touch again on the long-term returns and the capital return. This is really important. Lucy mentioned the numbers at the beginning. We've raised a total of 70 million back in 2014 and 2015, 70.1 across the IPO and a subsequent placing. We've only ever returned capital since then. We've committed to only ever return capital. We're not going to be issuing new capital. So we do feel that on its own should justify us trading much closer to our NAV. Everything in our portfolio is listed. We provide our NAV on a daily basis. There aren't any concerns about the quality of our portfolio from a price reporting perspective. And you can see, this has been a brilliant way of pro-cyclically raising capital from the portfolio and handing it back to clients, to shareholders. We raised 35 million. It's about a third of our current NAV today in 2021. In hindsight, that is a brilliant time to be raising capital and giving it back to shareholders. 2018 was also a pretty good time from a microcap perspective to be returning capital to shareholders. So we think this is absolutely the right strategy, and we're going to stick with our guidance of returning capital between 110 and 130 million. So I'll wrap up there and open up for questions. I guess just to point out a few things. We've mentioned M&A. The average premium that we've seen for that M&A has been 64%, which is indicative of the opportunity in the portfolio. We have about 50% upside on a 12-month view on our average base case for our portfolio. So the portfolio is very cheap. It's very high growth. You can see there on the right. This is from our analysis of looking at the portfolio. 3-year revenue growth of just short of 20%, profit growth of 50% per annum. Please take that profit growth number with a pinch of salt. These are very small companies that are often starting with very low levels of profitability. And so clearly percentages in those instances can be quite generous. And that's not adjusted for additional share count. So that's when companies are issuing equity and acquiring, that's going to benefit that number as well. Largely free cash flow positive. Very little of the portfolio has high net debt to EBITDA. And a free cash flow yield of just below 6%. So I'll stop there and open up for questions.
George, thank you for your presentation this morning. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab situated on the right-hand corner of your screen. Just while the company take a few moments to review those questions submitted today, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Lucy, can I please ask you to read out the questions and give responses where appropriate to do so, and I'll pick up from you at the end.
Thanks very much. And thank you, everyone. We've got quite a few questions, which is always nice to see. George, we've got a couple of questions around MPAC. What the investment case is, how big is the upside, and then has it adapted to the US tariff situation and potential volatility in that going forward?
Okay. So MPAC is a business that provides bespoke, quite highly engineered automated packaging solutions into both, predominantly healthcare and food manufacturers. So you can think of like a Nestle as a kind of client that they might have. And so they're enabling the automation of those companies' manufacturing processes. The business is a buy and build. So interestingly, that's a very fragmented industry. And clearly, it's pretty important to MPAC's clients that those solutions work and have very high uptime. It is predominantly a kind of original order business rather than a services business. And so you get cyclicality. If Nestle decides not to launch a new product or automate a new line, then that brings uncertainty into MPAC's business model. And so the buy and build is interesting because you can acquire capabilities that MPAC don't have, and then you can offer them to MPAC's existing client base where you've got these very long-term trusted relationships. But you can also buy into new relationships and cross-sell the existing capabilities. So that's quite an interesting, attractive, particularly how fragmented the market is to go and acquire businesses. And they acquired They acquired 2 businesses last year, I think early last year. On the tariffs, I think that they don't have a direct tariff issue in terms of importing stuff to the US and paying a premium on that. Albeit if they did, this is quite a high engineered solution. I think that the pass-through of that would be fine. What they do have a challenge with is uncertainty. And clearly, you are reliant on companies having 3, 5, 10-year capital commitment plans, following those plans through. And their clients probably are impacted by tariffs. And so you don't therefore necessarily follow through with kind of upfront CapEx decisions. So the business got hit. They came out and updated the market that they'd seen kind of a stalling of the order book moving into revenue. That came through in numbers. It feels like they've stabilized. The market penalized them for that. That's obviously going to happen. It's a sensitive market for momentum. But I think we've probably got past that. It's now reasonably valued. They've actually delivered pretty good. We spoke about growth and quality. This is a growth investment case. But they've actually delivered some pretty impressive improvement in return on capital as well. They took the opportunity of having less to do, less activity, less coming in the top of the hopper to restructure their US business post the acquisitions. And that's going to deliver them some decent margin opportunity. So looking forward, I think there's a cyclical, so slightly uncertain, but cyclical revenue opportunity, both organically and inorganically. And I think they'll continue to deliver on their margin improvement plan as well.
And is that stabilization a fair representation of the rest of the portfolio in relation to the US tariffs?
Yeah, we haven't. I mean, direct exposure, we've had very little. I think if you think about everything that companies have had to take on in the last 4 or 5 years, they've got pretty capable at kind of planning and adapting. So, I would actually look at it and say, I think from a delivery perspective, this January has been one of the best. I would probably almost certainly get a profit warning now I've said this, but it's been one of the best for, we have an update on where the company's actually reporting versus where our expectations are. I said over 70% of the portfolio is reported this month. That's to have only one, and in fairness, a small company, 1% holding, to only have one position that's kind of disappointed is pretty rare. We track the whole portfolio on whether or not the company outperformed, delivered in line, or missed expectations the last time they reported to the market. And we're at about 54. I think we're 50% beating, 45% in line, and 5% missing. So again, that's pretty good for usually companies are missing a bit more often than that.
Okay, interesting. Thanks. And another question coming in is, Kooth looks incredibly cheap. Are you buying more? And what's the investment case there?
So we the investment case is broadly unchanged. They're a provider of digital mental health services. They won the Californian contract. Would have probably been 3 years ago now. Big contract, competitive tender. That's actually been pretty successful. They're one of the companies that has updated in January, and I think it was actually yesterday or the day before, with a positive update. It's the challenge the market's got with Kooth is it's very difficult to gauge the probability that Californian contract renews next year. So the company are very keen to put out evidence to say this is going well. And one of those bits of information this week was the total number of users, 144,000, is ahead of where the target was for 136,000. So that's useful. For me, actually, the more impressive thing was that one of the largest county in California, which is LA, has gone out to ask other vendors that also provide services to children and young people to show the state how they're going to interact with Kooth. And so that's the kind of thing you encourage if this is clearly an evergreen contract rather than a 5-year contract. So there's evidence coming through. They've won a couple of other contracts in the US. The business is very, very cheap. The UK's got budget constraints on kind of additional revenue. They're going to bring their US tech into the UK. It's net cash. I think it's got 20 million of cash on the balance sheet. It's doing 10 million of EBITDA, and it's got a very low market cap. So it's very well set up. We bought a little bit more a couple of weeks ago. But we've got. I mean, we're pretty large shareholders. I think we're just below 10% of the ownership of the company.
Okay, we'll watch and wait. Could I just confirm with you? Is there a point at which you are forced to sell a company if it becomes too big in market cap terms?
Yeah, so it's really important we don't have that forced selling point. The only time we're a forced seller is if a company becomes 10% of the trust, and that is why we've been selling DF Capital for the last 6 or 9 months. It's really important we can run these market caps. These are growth momentum companies. They can re-rate significantly. ActiveOps has re-rated from 1 times to 3.5 times. We don't think that's the re-rating done. DF Capital's re-rated from 0.3 or 0.4 times book to 0.9 times book. So we run these. But Sigma Rock is one that we've had for a long time. We've made very good money on it. It's performed very well, but the synergies from the big CRH deal are now largely complete. The disposals are complete. I'm sure they'll go off and do some more M&A. And you've got the German stimulus coming through, and you've potentially got some cyclical recovery in Europe. And hopefully you've got a recovery in Ukraine if there's a successful outcome to the peace talks there. So there's plenty of drivers. That's now a proper small cap. It's 1.4 billion market cap. We've still got a 2% position. We've brought that down from a top 10 position given the recent performance, and as time goes by, we'll probably recycle that unless we can make a stronger case for upside into some new microcaps.
Okay, thanks. And then there's a question about Saba, which I feel like Saba have become fairly mainstream investors now, but a question asking that given Saba have a significant holding in microcap, have they communicated or discussed any intentions with the board?
So Saba have been a shareholder for quite a long time. They've taken their stake up. They were a shareholder at our last continuation vote, which Lucy, you'll know, but March 23 or 24.
Yeah, March 24, I think.
So that, you know, I don't know, so I won't say. But there haven't been any kind of strong activism from them. They've been high profile about wanting companies to return capital and do buybacks. We have a buyback. There's an ongoing £2 million buyback at the moment. People will be aware that we went through a kind of capital return refresh in the summer. We went out and spoke to lots of our institutional shareholders. I think we spoke to 40-ish%, 45% of the register. And we said, look, you know, we are confident of what we can do in this microcap trust. We're confident that when the market returns, we will be able to deliver the type of returns that people expect from a microcap trust. But look, if we don't, then what we'll do is in June 2028, if we haven't got to at least 110 million of NAV, then we'll put a vote in place, and we will encourage people to vote for the wind up of the company. So it was like an insurance policy that if this just isn't going to work ever again, then we'll give people their capital back. And I think that's absolutely the right thing. I'd be hopeful, given the performance we've delivered over the last 9 months, that we absolutely will get to 110 million. And I hope as the discount comes in, we've traded on a remarkably wide discount. We've traded on a wider than sector average discount, despite materially better than sector returns. You know, I get it. We've been through a really tough time for microcap companies, but that's improving. And I think we've got a job, you know, River and the board, to get out. We want retail participation. That's why we've been doing these updates. We want to find new shareholders, and you know, I think we've been going into this in earnest for 9 months, and I think the traction so far has been good.
Yeah. Okay. More questions around the portfolio makeup. So, what percentage of the fund is in precious metals, and which holdings do you have?
So we've got Sarabi Gold. It's about 4%. We've got Capital Drilling. Capital is now was Capital Drilling, which is top 10, kind of 4.5%. We've got Sylvania Platinum, similar. So I think it comes to 13% in total. Very strong momentum in those companies. We don't, you know, as I said with Sylvania Platinum, if you run spot, and I know spot is extremely elevated at the moment, but if you run spot, there are massive upgrades to go for. If we put in what we think are sensible commodity prices, then you still have very cheap companies. They're net cash, highly cash generative. So we're running those, but we have been profit taking from time to time, and we'll continue to. We don't want to have a too large exposure to precious metals. Capital's pretty interesting because it's a picks and shovels play. They provide the drilling equipment to gold miners. They've come out openly and said that they've got a lot of incoming, as you would expect. You would expect them to be able to take some rate this year, given where the cycle's at. And so that can, in theory, boost their returns and their margins. They did a placing last year to raise some capital to buy some more kit. That looks sensible. Looked sensible at the time. Looks more sensible now. We participated in that. So yeah, they all look pretty well set. Capital's also actually got a portfolio of gold E&P stocks itself, which has performed extremely well and is quite a big chunk of the market cap now.
And are you seeing more liquidity in the market when you want to sell down chunks of shares?
Yeah, we don't that often sell chunks of shares is what I would say, other than when there's been a bid and we exit a position. That's certainly been what's happened recently. But we haven't had challenges exiting positions. We've got a very short tail at the moment. We're down to 33 positions. Guidance is 30 to 50, but I think of that probably as 30 to 40. It's certainly been kind of 30 to 35 over the last few years. But I do think there's encouraging signs that there's interest in the market, and liquidity I don't think has been an issue actually for the last couple of years. It's just been the sentiment has been so depressed, and then a company will come out with a bit of good news and it'll go up 10 or 15%, and people will start selling it. And I think people that just look at UK small caps probably have a view that if it goes up to 12 times earnings, that's quite a high price, and you can recycle some stuff into a cheaper company. And if you look at it on a global context, UK small companies are outrageously cheap.
Yeah. Moving on to Gear for Music, which I know is one of your favourites. Does Gear for Music underline how quoted small caps can still progress in what is a very sluggish economy?
Yeah, I mean, it's a great example. I think their peak trading was high 20s or 30% growth. That's clearly not indicative of the market. That's indicative of them taking substantial share. It's been a really tough market for quite a long time. Everyone's stocked up on the coming out of COVID. All these online retailers stocked up because they've been through 6 or 9 months having lots of demand and no stock to fill. So they stock up, demand rolls, and you have this long kind of painful inventory drawdown, people going very competitive on price. And, then as either online retailers or high street retailers are struggling, they move to even more aggressive pricing to try and get cash out of their businesses. So we've been through that cycle. And yeah, Gear for Music is great, but there are lots of businesses. We'll go back to this point here, 3-year revenue growth of 20%. Now with 50% domestic, 50% international, and not all of that will be organic, but nevertheless 20% revenue growth. And if you dig into the profit growth from a CAGR from 3 years ago to today, Gear for Music would be a very good example of a business that has delivered very high profit growth. DF Capital will be another example. Active Ops will be another example. There are plenty of companies that have delivered very high profit growth.
Thanks. And do you think Get Busy has turned a corner where growth momentum is now building with their core products?
Yeah, so they're another company that updated in January. I think they updated 16 or 17% ARR growth for SmartVault, which is their US business. I think that's very well placed. They're one of the companies that's got a kind of significant gearing to the exec team that if they return cash to shareholders, then they take a geared, ratcheted share of that cash that gets returned to shareholders. My view is that's based on them growing that business. They've been pretty open about this, growing that SmartVault business and selling it in the US, where obviously tech multiples are higher. Get Busy is another good example. It has been through this period of pretty sluggish growth. The growth is accelerating. I think expectations are sensibly set. It's got a little bit of net cash, so the balance sheet's fine, but it's still on a very low multiple of sales.
Thanks. And what are the dangers from AI in some of the stocks, Active Ops, for instance?
Yeah, so it's a good question. So we would think about AI in a couple of ways. There are going to be businesses that get disintermediated by AI, but I think vertical niche software business have a lot of IP in them, and I think there's now a lot of expectation that lots of these businesses are going to get disintermediated, and some of them will, but a lot of them are probably going to be enabled by AI more than they're going to get disintermediated by AI. So I think if you put that question to the management team of Active Ops, they'd say, well, actually, the proposition we can go to customers with, I don't think they'd concede this, but maybe they'd concede that they can charge a little bit. They can't charge quite as much But I think they'd say we can charge the same amount. Our proposition is better because it's been AI enabled. We're providing these outcomes, and the fundamentals will point to that at the moment. It's not actually a company we've got in microcap, but in the small cap fund we've got On the Beach. And On the Beach is, you go onto their website or onto their app and you book a holiday. And so that's something where people would be like, well, obviously, like, I'm going to have an agent in my pocket and my agent will know what I like. And so why wouldn't they just book my holiday for me? And there's a few kind of really good defenses on why that business might not be disintermediated. One is that it gives you an interest-free loan for 6 months to pay for your holiday. So you book it today and you go in July and you pay monthly. So that maybe AI will enable loans as well, but seems quite unlikely. You're atoll protected, and that everyone now has a greater appreciation for post-COVID than they did pre-COVID. And also, actually, the number of different combinations of flights, transfers, hotels, countries is massive. And AI can do that, but On the Beach have already done it. And so my guess would be, I don't know, we were having this conversation on the team recently, but I think we're quite close to the kind of view that everything is going to get disintermediated by AI. Some will, some won't. But all of these businesses have just been massively derated. And so we haven't really started trading this yet. And I wouldn't have said there's that many opportunities in microcap. But there's been a lot of derated companies in small cap. And I think we're probably closer to buying back into those than being cautious on them.
Okay, thank you. I think we'll stop the questions there. For those of you where we haven't answered the questions, apologies, they've come in thick and fast. But we will come back to you via Investor Meet Company in due course.
Guys, that's great. Thank you for answering those questions you can from investors. And of course, the company can review all questions submitted today and publish those responses on the Investor Meet Company platform. Just before redirecting investors to provide you with their feedback, which I know is particularly important to the company, George, could I please just ask you for a few closing comments?
Yeah, I think we've been through a long cycle of very negative sentiment towards small caps, micro caps, UK equities in general. I think we can pretty plausibly argue that it's unjustified now. We've seen a great year for FTSE 100 performance. We've started to see smaller companies outperform. We're getting great updates from our holdings, which have delivered well, are cheap. So we're excited about what this year holds, and we are going to be out on the road trying to market the trust and get the discount closed out.
George, thank you for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure be greatly valued by the company. On behalf of the management team of River UK Microcap Limited, we would like to thank you for attending today's presentation, and good morning to you all.